Let's turn our attention back to the oil markets now. We are seeing a rebound in this session, both WTI crude and Brent up more than 4%, almost 5% right now. But new data out from the EIA fueling oversupply concerns yet again. Inventories rose last week by 1.9 million barrels. Meantime, traffic appears to be close to resuming in the Suez Canal, providing some relief to delivery concerns. Let's bring in Stephen Schork. He is the editor of the Schork Report. Stephen, what does the demand picture look like for you? It seems like on the one hand, there's a lot of optimism in the markets on the expectation of economies around the world reopening, and yet it seems to be this push and pull, concerns about oversupply, sort of capping the gains we're seeing in the session today yet again.
Well, we have to keep in mind that from a demand perspective, things look rather impressive given how far we've come in a relatively short amount of time. Last week, we had the latest batch of numbers out, and we see that wholesale inventories of petroleum products, that ratio relative to retail sales is back within historical norms, of course, after falling off a cliff last summer. So the market has done an excellent job of rebalancing. That rebalancing has come as producers, both OPEC, Russia, and here in North America have done a good job of curtailing their output. So with regard to supply, the market is more in balance. Yes, we are in the midst of a strong rally today, but that's only comes on the heels of a massive sell-off, a $4 barrel sell-off yesterday. So the market's in the process of balancing itself out. Keep in mind that we've rallied from about $30 a barrel before the winter to upwards of, we knocked on the doorstep a couple of weeks ago of $70 a barrel. So we've had a terrific run over this one season. We're now at a level 57, 58, the high 50s, low 60s, which is more or less where the market was trading in 2019, i.e. the year when the economy was strong. No one heard of COVID. So we've rallied right back up to that level. We might be a little overheated, might be time for a pullback. We are at a time of the year, refinery maintenance season. When refineries do go offline, they retool, they refuel, so forth to get ready for the summer. So the refineries, the only people that actually really buy crude oil in the market to use are not buying as many barrels as they normally will come a month and a half from now. So from a demand perspective, we're at the nadir of the season. But as the weather warms, we move towards Memorial Day, the holidays, so forth, demand will pick up, and this certainly should add more support to the market going into the summer.
Yeah, and Stephen, I mean, I remember talking to you earlier on in the year. Obviously, this was before kind of that surprise sustained cut from Saudi Arabia. We were talking about $55 maybe being the top price range here. Obviously, it's been a while, but you got Goldman calling for $80 a barrel later on in the year. I mean, where do you see the long run, I guess, price target maybe investors should be looking for in the back half of this year when all these kind of supply demand issues square away into where you see us settling in?
Yeah, fine, Zach. Yes. And as the old saying goes, yesterday's resistance becomes today's support. So we are looking at a level. We're now hovering right around that level where we traded for the better part of 2019. The Dallas Federal Reserve Bank just came out today with their survey of the oil patch. That is the 11th bank district, incorporates Louisiana, Texas, and New Mexico, i.e. the oil patch. They're looking at break-even oil prices that will keep their wells operating at $38 a barrel. And even on the high end, what these E&Ps need to see to make money in the new year, the highest case we're looking at is $58 a barrel. So I have no problem now seeing that as support in the market. So that is to say, the current pullback we're seeing over the past couple of weeks, should it continue, we're going to run into support, I do believe, in that high $50, mid $50 range. Going forward as demand picks up, and look, I do think that there is a tremendous amount of latent demand in the market. Now, the macroeconomic headlines that are going to come out, the Chicago Fed National Activity Index, and the latest rash of numbers are going to disappoint because they're going to incorporate the February numbers. And as we know, the economy ground to a halt, especially through the mid-continent. So those are going to be one-offs. But certainly, I do think there is a tremendous amount of demand. If we just look at the supply chains, the automobile manufacturers holding back production because of a chip shortage. Well, if they're holding back production today, day, that's just more production that's going to hit the line once these supply chain snafus work out. So there's a lot of demand in the market. So yes, I think another run back towards 70. This is WTI, back towards 70, and in that low 70, mid $70 range is a absolute reasonable target as demand picks up this summer, and that would translate low to mid 70s. WTI would translate to high 70s, potentially $80 for Brent oil on the global market.
Is that with the summer surge baked in? I mean, you mentioned that we're likely to see a big surge in activity more in the summer, especially when you consider, for example, in the U.S., the vaccination supply will already be there. Europe going through some hiccups, but potentially able to accelerate their vaccination rollout as well. How much of all of that surge in activity down the line has already been baked in?
I think a significant amount has baked in, and hence why we are getting that pullback at the weakest time of the year. But I think we're just reloading the gun at this point. To your point, look, everyone's fed up. We're not going into the draconian lockdowns. I just don't think here in North America, Europe, Asia, so forth, people have had it. So we've already seen a nice rebound in gasoline demand. Now, to your point with being baked in, what the really positive to come out of COVID is the consistently strong demand for diesel fuel. Now, diesel fuel is your primary industrial fuel, and that never really took a significant hit. It obviously took a hit at this time last year when everything took a hit, but it was the first energy market to rebound, and it stayed strong, and we're at very high levels. So to me, when we look at industrial commodities, this is your best leading indicator. So whether we're talking about the movement of petroleum, the movement through air cargo, trucks, barges, so forth, the latest numbers that have come out are very positive. So there is that the psychology of the market, shall we say, has been baked in. Now we're just waiting for the fundamental confirmation for it to be baked in. So we've had the run up. We'll have the pullback now in the spring months when demand's at its weakest. But if we are correct, we don't go into another set of COVID lockdowns like last year, that demand certainly should be enough to propel us back above that 70, even with Brent in that towards that $80 range.
Well, Stephen, we always appreciate getting your insight in on the oil market. Stephen Schork, the editor of the Schork Report. It's good to talk to you today.